Most incorporated Canadians are great at building wealth inside the corporation, but not always great at pulling that wealth out efficiently. And that's where we're going to talk about these two notional accounts today. Tools like the Capital Dividend Account and tools like your RDTOH, which is your Refundable Dividend Tax on Hand. These let you turn investment income or insurance proceeds into a tax-free or tax-refunded distribution. But you really need to understand the rules to use these things properly. Hi. My name is Laurent Munier. I'm a partner and I'm an advisor here at Safe Pacific Financial, and in today's video, I'm going to explain how these accounts work, why your accountant probably isn't explaining them well enough to you, and how you can use them to build smarter tax strategies for both income and estate planning. So what are these notional accounts? Now, before I start, I have to say, these are not accounts that we would help you set up. Everything I'm going to talk to you about today is something that you talk to your accountant about. Your accountant will track these accounts and should consult with you on when to access them and how to access them. So don't call me about any of these, call your accountant. That means today's video is 100% giving value back to you just for watching. I'm not asking you for anything except for maybe a like and a share for the algorithm at the end. And seriously, you don't have to wait to the end. You could just click the like button right now. It's right below the video and it's super easy. Let's get started. So in Canadian corporate tax planning, a notional account is an essential bookkeeping tool that's used by private corporations to track certain tax attributes. But they're not actual cash sitting in a bank account. They're paper-based tax tracking mechanisms is what they're called, and they play a crucial role in determining how much tax a corporation has already paid and how much tax can be refunded and how much can be distributed to the shareholders in a tax-free manner, all things that you want. So although these accounts don't show up on your corporate balance sheet, understanding them is key if you want to get money out of your corporation in a tax-efficient way. These notional accounts allow you to benefit from the tax integration system in Canada, which makes sure that income earned through the corporation is not unfairly taxed twice when it's paid out to shareholders. So there's multiple types of notional accounts that you can get access to under the Canadian Income Tax Act. And today I'm going to talk about two very important ones, especially for business owners and for high-income incorporated professionals that watch this channel. Thanks for watching. Number one, it's called your Refundable Dividend Tax on Hand, or RDTOH. So RDTOH is a notional account that tracks the portion of corporate taxes that have been paid on investment income. So this would be interest, dividends, taxable capital gains. Canadian tax system imposes additional tax on passive income that's earned inside your corporation, which we've talked a lot about on this channel. But to avoid overtaxing that income when it's eventually paid out to shareholders, some of that tax is held in what's called an RDTOH account and can be refunded when the corporation issues a taxable dividend. So as of 2019, RDTOH is split into two parts. You have eligible RDTOH, which is ERDTOH, and that tracks tax paid on investment income, and that supports what's called your eligible dividends. So now this next one is kind of my favorite, not because of anything technical or for anything it does, but just because it has a funny name. It's called a non-eligible refundable dividend tax on hand. Thank you, the nerds who invented NERDTOH, non-eligible refundable dividend on tax on hand, spells NERDTOH. Haha. Anyways, this tracks tax paid on other types of passive income and investment streams when you're paying out non-eligible dividends. NERDTOH. So when a corporation pays out dividends to shareholders, it can recover some or all of the taxes paid by claiming RDTOH. This aligns the total tax burden between corporate and personal tax rates. So this ensures your income integration and it reduces the likelihood of double taxation. Now, if you're an incorporated professional and you've got investment income in your corporation, properly managing your RDTOH can result in tens of thousands of refunded taxes. But it really requires careful timing and it requires coordination with your tax team and your financial planning team. Now let's talk about your Capital Dividend Account, your CDA. So if you've followed this channel for a while, you already know this one. The CDA is a powerful tax tool. It's a planning tool. It allows Canadian private corporations to pay out a tax-free dividend to shareholders. Now, who doesn't like receiving a tax-free dividend? Unlike regular dividends, which are taxable to the recipient, capital dividends paid from your CDA are completely tax-free. So this is a notional account and it tracks non-taxable amounts that flow into the corporation. So some of these things are the other 50%, the non-taxable 50% of a capital gain that you earn inside the corporation. Also, the death benefit from a life insurance payout. So if your corporation receives a life insurance payout, that amount minus the policy's adjusted cost base or ACB can be paid out through the CDA with no tax to the shareholders. Also, capital dividends that you get from another private corporation. So these are three of the big things that will affect your CDA. When your corporation accumulates a positive balance in your CDA, you can pay out a capital dividend by filing a CRA form, and then you can pay that out to your shareholders without any personal income tax. Like I said at the beginning, this is something that your accountant would track or should track, and then you talk to your accountant about when do you want to pay this out. But really what this does is it makes the CDA really an important planning tool for estate planning, for corporate succession, and for just getting money out of the corporation in a tax efficient way, right? Like we pay enough taxes, so having some tax-free things, I like it. Now, your CDA must be managed properly because if you pay out too much, it can result in severe penalties, and you need to accurately track, or your accountant needs to accurately track the balance, especially after an insurance payout or if you had a capital loss. Those are really kind of two places where you could screw this up or where your accountant could screw this up. Now, why do these notional accounts like your RDTOH and your CDA, why do they matter for business owners? So if you're incorporated, you're a professional, you're a business owner, or you're high net worth and you're using a private corporation or a holding company, understanding these notional tax accounts is really important to building and preserving long-term wealth. Now, these accounts, especially the RDTOH and the CDA, are really important for Canada's tax integration system, which is really designed to ensure that your income earned through a corporation isn't unfairly taxed again when you pay it out to shareholders. So when you manage these things properly, the RDTOH and your CDA, they can create significant tax efficiencies, so which can let you pull money out of the corporation in a way that's aligned with your both corporate and your personal tax rules, and can be pulled out while minimizing tax or eliminating it completely. And these are not just theoretical accounting mechanisms, right? They directly influence how much real after-tax money ends up in your hands or in your family's estate if we're talking about a life insurance payout. So now, why are these accounts so important to tax-efficient wealth planning? Together, the RDTOH and the CDA, it's like the backbone of an advanced corporate tax strategy for Canadians. They allow you to do 5 main things and more, but these are the big 5. So number 1 is to reclaim previously paid corporate tax on investment income. So that's through your RDTOH. It allows you to distribute tax-free capital to shareholders. That's through your CDA. It allows you to minimize or eliminate personal income tax on some of these corporate distributions. Again, this is through your CDA. It also allows you to structure corporate-owned life insurance in a way that benefits both your retirement and your estate plan in the future. And it allows you to align personal and corporate tax strategies under Canada's tax integration rules, which means that there shouldn't be an advantage tax-wise for pulling money out personally or corporately, right? It should be integrated and it should be fair and the same. So here's some final thoughts. Let's wrap it up. You want to use your CDA and your RDTOH to maximize the tax efficiency and to pull money out from your corporation. That's really what these things are here for. So if you own your business or you're an investor with significant retained earnings inside your holding company, talk to your accountant about your RDTOH, which is Refundable Dividend Tax on Hand, and your CDA, which is your Capital Dividend Account. They're more than just line items on the balance sheet. They're really an important tax planning tool that can help you to pull money from the corporation in a smarter and a more tax efficient way. Now, you really need to understand, how do these accounts work? And more importantly, how do you strategically use them and when do you use them? And this can be the difference between overpaying tax and keeping money in your pocket and building lasting wealth. The RDTOH lets you reclaim corporate taxes when you're paying dividends, and the CDA allows you to distribute these capital gains or life insurance proceeds tax-free to the shareholders. Together, they support advanced strategies in either retirement planning, succession planning, estate distribution, investment income management, or even corporate-owned life insurance planning. If you're planning on selling your business in the future, or funding your retirement, or leaving a tax-free legacy, or reducing taxes on the investments that are inside your corporation, you definitely need to integrate your RDTOH and your CDA into your financial strategy. They're not just technicalities, they are important parts, and they're totally legitimate parts of Canada's tax system and tax integration. And you really need to understand these, because we've seen people not understanding these and not using these because their accountant hasn't talked to them about it. So bring up RDTOH and bring up CDA with your accountant and see if there's this money sitting inside your corp that you can pull it out. Now, if this is something that you want, if you want some sort of like a customized strategy that's tailored for especially a corporate owner, this is what we do. I'd say Pacific, we work with Canadian professionals, we work with business owners who want to build their wealth and who want to go beyond basic planning. We'll show you how to leverage these accounts. We'll show you how to leverage your corporate structure in combination with your holding company or corporate-owned life insurance, and how to structure this to fit your retirement investment strategy, right? So that you can pull more money out of your corporation and put it into your pocket to spend on the things you want, and to send less money to Ottawa so that they can spend the money on things that they want. Generally our business owner clients like to decide where their money goes, and they generally don't like sending it to Ottawa so that Ottawa can decide where that money goes. Now, to get started, super easy. Go to our website. It's safepacific.com. There's a contact form on there. There's also lots of buttons that you can click to book a no-pressure consultation. During that consultation, we'll create a personalized plan and a strategy based on your family structure, based on your corporate structure, based on your long-term goals, and based on the tools that are available in Canada's Income Tax Act. Now, like I said, we don't set up your RDTOH, we don't do your CDA, we don't do any of that. That is for your accountant to do. So today's video is 100% just giving you information to help make your relationship with your accountant better. Now, if this video helped you and it helped you to make sense of these notional accounts like your RDTOH or your RDTOH or your CDA, like I said, the only thing I'm going to ask for you today, hit like, hit subscribe. This is what we do all day, right? We help Canadians with their tax strategies. We help them with their investments. We help them with their insurance. And incorporated Canadians that are profitable, there's not a lot of us. So please, hitting the like button, hitting the subscribe button, hitting the share button, leaving comments. This really helps the algorithm and the robots to share this type of information with more business owners like you. Just the little like actually really helps to get these videos out to the right people, because I'm competing against Mr. Beast, who's handing out millions of dollars running basically reality shows on YouTube. And I'm making videos about notional tax accounts and life insurance, not a fair battle. I need help boosting the algorithm. So that's it for today. I will see you next time.